In this video, I'm going to look at how to read a company's balance sheet. First, I'm going to look at the main sections of the balance sheet, and then I'm going to look at two metrics, two ratios that are extremely important for company sustainability and long-term growth. So let's get started. First of all, if you are not subscribed to the channel, you can do this by pressing the subscribe button under the video. It is absolutely free and you will not miss a single new video. Company's balance sheet is one of the three most important statements of the company, along with the income statement and the cash flow statement. It is possible to make the balance sheet on any day. So it is best to take the balance sheet from the latest 10K or 10Q report. What I'm going to do is I'm going to use Facebook or Meta stock as an example and take balance sheet from the latest 10K report. First, I'm going to show you the main sections of the balance sheet, and then we're going to go each section in detail. So the balance sheet has three parts: assets, liabilities, and equity. First, let's look at assets. Just like a person can have assets like a house, cars, company too has assets. Company assets can be divided into two parts: current assets and non-current assets. Current assets can be sold within 1 year. The most liquid assets come at the top. Of course, cash equivalents can be treasuries, so they can be sold very fast. Cash and cash equivalents is extremely important because later we will use them to calculate net debt. There are also marketable securities like stocks, bonds, so company can invest in stocks, in bonds. Accounts receivables means that the company has delivered goods or services, but the customers haven't paid for them yet. There is also prepaid expenses. Okay, so these were the current assets. Non-current assets can be, for example, property, plant and equipment, intangible assets like trademarks, patents or brands. The important thing here is that company can list only brands that it purchased, so it cannot list its own brands. For example, Coca-Cola cannot list the brand Coca-Cola because it's their own brand. Another type of assets is goodwill, which means that if a company acquires another company for more than its book value, the difference would be goodwill. So these were the main assets that the company can have. Now let's go to liabilities. Again, for a person, a liability can be mortgage or credit card debt. So the same thing applies to a company. Liabilities can be divided on current liabilities and non-current liabilities. Current liabilities, it is liabilities the company owes that is due within 1 year. The example of current liabilities can be accounts payable. It is exactly the opposite of accounts receivable. It's the services and goods the company got but hasn't paid for them yet. Also, it is very important to look for long-term debt in the liabilities portion of the balance sheet. If we take cash and cash equivalents, subtract long-term debt, we will get net debt, which is very important when we calculate the intrinsic value of the stock. Also, it is very important that the net debt of the company is not larger than 4 times of net income. Company can rent properties, so there are lease liabilities and other types of liabilities. Okay, if you want to calculate the person's net worth, what we're gonna do is we're gonna take total assets and subtract total liabilities, and we get the person's net worth. Again, the same thing applies to a company. If we take total assets, subtract total company's liabilities, we get the equity. Technically, equity is also a liability to the shareholders of the company. On the equity portion of the balance sheet, we can see there is additional paid-in capital, which basically means the amount of capital that was raised during the IPO, and there is retained earnings. Retained earnings is the amount of net income minus dividends that is paid to shareholders. It is extremely important to look at the equity or book value per share of the company. If we return to the person analogy, a person can generate a lot of income, but if that requires to get more debt, the person will not get richer because his net worth will stay the same. So it is extremely important to look at the equity or book value per share of the company. According to Warren Buffett, book value per share growth is an extremely good predictor of the future stock performance. So how do we calculate the book value growth? We take all the assets, subtract total liabilities, and we do that for many years. As we can see for Facebook, it grew its book value consistently for the recent years, except for the recent year. But Facebook repurchases a lot of its shares, and if we look at the same chart but on per share basis, we can see that even during the last year, Facebook managed to increase its book value per share. Okay, so we looked at the main sections of the balance sheet. The two main ratios to look for. First is the net debt, which for a sustainable company must be no larger than 4 times net income. And the second metric to look for is the book value per share growth, which is an extremely good indicator of the future price performance, according to Warren Buffett. Here is the video where I described where to get the book value per share growth. If you are not subscribed to the channel, you can do this by pressing this button. Thank you very much for watching till the end, and see you in the next video.